Let's dig into Netflix a little bit more, though, right now, because, again, we are seeing a decline in the shares here. That's even after Netflix added 10.1 million paid subscribers last quarter. It has to do in part with the lackluster forecast for this quarter. One more thing to mention, which we will also talk about, Ted Sarandos becoming the co-CEO alongside of Reed Hastings. Let's bring in Geetha Ranganathan. She is Bloomberg Intelligence Analyst. She's joining us from New Jersey. Geetha, it's good to see you. So as we look at these Netflix results, on the whole, it doesn't look terrible. The forecast is indeed short. But do you think part of the disappointment that's being reflected in the shares just has to do with the fact that the stock had performed so incredibly well?
Yeah, thank you, Julie. And I think you're absolutely right. So at first flush, obviously, it's a little bit of a tepid outlook for 3Q, a company guiding to about 2.5 million subscribers. That's half of what consensus was expecting. But then you kind of have to just take a step back here and look at the big picture. I mean, if you just look at the first half of the year for Netflix, they've already added 26 million subscribers. That's just 2 million subscribers short of what they added throughout 2019. So yes, definitely it looks a little bit tepid, a little bit modest in terms of outlook. But then again, I think the long-term growth story is still very much intact. And having said that about 3Q, I think management is just being a little bit conservative here. I wouldn't be surprised if they kind of under-promised and over-delivered, because you look at the content slate, it looks pretty solid for 3Q.
Geetha, let's talk about the other announcement that came out yesterday that Julie alluded to, which is Ted Sarandos being named the co-CEO. He, of course, is a familiar name, has kind of been a steady hand in bringing in all the content that Netflix is known for now. Reed Hastings says this is kind of just making official what was already in place. What do you see changing as a result? Or is this just about sort of giving him sort of that additional title, but the role staying the same?
I think exactly. It's pretty much the same. It's going to be business as usual, as Reed Hastings pointed out. I think what this really does is that investors have kind of been questioning about whether Netflix has a good succession plan in place. And I think this is really about that, having that succession plan in place. And kind of just formalizing that. I mean, Ted Sarandos, as you pointed out, has really been a force. He's been a very big force at Netflix. He's been the architect of the originals strategy. And what you really see here is this marriage of technology and content. So there's this perennial question with Netflix about whether it's a technology company or a media company. Reed Hastings, as you know, is the architect of the technology side, coming up with the best user interface out there in the ecosystem. But then you look at Ted Sarandos, and he's kind of really developed this secret sauce when it comes to content. This is why Netflix has such an advantage. You know, content is the big differentiator. Netflix has been able to go and establish all those relationships with A-listers in Hollywood, and that's kind of what's giving them that boost on the content side. So it's really this perfect marriage of both worlds, if you will.
Hey, it's Brian Chung here. Everyone wants to focus on the content side of things, but what's interesting to me is the finance side of Netflix. Obviously, this is a company that has a lot of debt as it's financed a lot of the projects to expand the content library that it has. When you looked under the hood of the results yesterday, what did it tell you about not only the debt load that it has right now, but also with new management changing, what its approach is going to be to either A, investing more and spending more money so that they can increase the content library, or managing that debt down?
Yeah, so that's a really, really good point, Brian. So one thing that they came out and said right away is they're not going to look to the debt markets for the rest of the year. You look at the cash balance, it's $7 billion in cash, so pretty strong financial position right now, at least as far as the balance sheet is concerned. Of course, the other thing that investors constantly question about this company is the free cash flow growth potential. And for the first time after a very long time, in the first half of 2020, we're actually seeing no cash burn. We're seeing them be free cash flow positive. And there's always kind of been this question about, can this company actually be free cash flow positive? And they provided some evidence of that. Of course, we're going to see that number jump around quite a lot because content productions now are on a pause. but that's going to change as the economies kind of open up. And so we're going to see that free cash flow number obviously again turn a little bit negative in 2021. But I think it kind of goes to the long-term question of this company does have a great amount of leverage in its business model. And I think whenever they've accessed the debt markets, Brian, you would see that investors are willing to give them a pass because it really helps them to kind of build that competitive moat. But right now, the situation from a financial standpoint looks really, really promising. It's not just this hyper focus on subscribers anymore. They're showing some really tangible improvement in their financial results, especially with their operating margin kind of expanding steadily, as well as that free cash flow number.
Geetha, I want to expand upon that for just a moment as we look at the free cash flow, the spending on production, and the addition of subscribers. Because, as you say, spending is probably going to ramp up again next year as production opens back up. Is there an equilibrium for Netflix at some point? They have to keep making new stuff. And as we know, the addition of the international subscribers is not as profitable for them. So is there a long-term positive free cash flow situation, a stable one, in the cards ever for Netflix?
I absolutely think there is. And we kind of got a little sneak peek into that in 2020. They kind of alluded to that yesterday when they actually kind of over-delivered on their free cash flow number. Of course, we're going to see that number be pretty choppy, Julie. There's no way to sugarcoat that. We're going to see a ramp up in production. We're going to see a ramp up in content. At the end of the day, the only way that they can reaccelerate their subscriber growth is by spending on content. And so that free cash flow number is obviously going to bounce around quite a bit. But I think at the end of the day, you also have to look at scale. And you have fixed content costs. And as they're able to spread that out on a much larger subscriber base, they do have a lot of operating leverage, both in terms of profits as well as in terms of free cash flow. And you ultimately see that whole virtuous cycle really in motion with that subscriber growth driving profits, and that in fact enabling them to then invest more in content. So absolutely, over the long term, yes, we're going to see some short-term choppiness, but I think over the long term, definitely a free cash flow positive story after about 2 to 3 years.
All right, Geetha, thank you so much for your insight. Geetha Ranganathan is the Bloomberg Intelligence Analyst who covers Netflix. Appreciate it.
Thank you.